Accounts Receivable and AFDA Problem 1. The following information is from the records of Banana Corporation. Accounts receivable on December 31st, Year 5, an $83,000 debit balance. Net credit sales for Year 5, $160,000. Accounts written off as uncollectible in Year 5, $15,000. Cash sales during Year 5, $45,000. The company uses the direct write-off method for bad debts. What is the amount of bad debts expense? This question focuses on accounts receivable, and students, they tend to get really stressed and really nervous about accounts receivable. It does get very difficult at times, especially when you're focused on allowance for doubtful accounts and AFDA. The good news is that in this problem, we're looking at the direct write-off method, which if you remember, under GAAP, under generally accepted accounting principles, the allowance method is required. However, some companies that do not follow or do not have to follow GAAP, they can use the direct write-off method, which is much more simple to understand. So not GAAP, you can use the direct write-off method. Now the idea, and by the way, the direct write-off method is what's used under tax law. The direct write-off method, when an account is considered uncollectible, it's just directly written off, making this a lot more simple. Because if you're looking at this problem and you want to stop for a second, you can see that the number, what it's asking is what is the amounts of bad debts expense in this problem. It's actually given to you in the problem. No calculations are needed. That being said, I still want to go over some things because as you know, these problems build on one another and I want to help you understand. So again, keep that in mind when we go in later problems that GAAP requires the allowance method. Now the allowance method, and we'll again talk about this in our problems as we see it, the idea is that we understand that businesses are not going to be able to collect all the accounts receivable. It's just not going to happen. It's a cost of doing business. You're going to have to conduct business on credit because your customers, not all of them are going to have the cash to buy. And if you want to obviously secure, you're going to have to make that available to customers to come to you as a benefit, and they'll go to your business over other businesses because if you didn't, you would lose sales. But we also understand that, so it's a double-edged sword. It's creating business, but we also understand that, hey, not all of the customers are going to pay back what they owe. There's a percentage. That's a cost of doing business. So under GAAP, they say you're going to basically estimate at the beginning of or end of the previous year, rolling over to the beginning of next accounting period next year, the amount of bad debts that you believe should be written off. And that's what the allowance method does through the allowance for doubtful accounts. That's why it's called the allowance for doubtful accounts. The non-GAAP method, direct write-off, is much simpler because you're not doing this estimate calculation. You just write off the account receivable when you know it's uncollectible. So here, this company uses the direct write-off method. If we're looking at the information, our accounts receivable, the net credit sales, the accounts written off in Year 5, and the cash sales, if we're asked what is the amount of bad debts expense, focusing just on this information, which this information all focuses on Year 5, it's just the amount of accounts written off during the year. That's going to be the amount of bad debt expense. So the answer is just $15,000. It's given to us in the problem. It's just this number right here. Now, if I asked you under the allowance method what the amount of bad debts expense is, I'd have to give you more information. You would have to know how to calculate the estimate for bad debt for allowance for doubtful accounts. And remember, when we write that, when we do that entry every year, that adjusting entry, to make sure that our estimate is accurate for the year, whether you're calculating it based on net sales or the aging of accounts receivable, whatever you're doing, that's when you are going to trigger that bad debt expense, not when you write it off. So just keep that in mind as you go through later problems.